All right, welcome to Chapter 3 video here. What we make sure you do is have your PowerPoint in front of you and your workshop curriculum guide, your study guide as we go forward. This should be a fairly good chapter to talk about net income and adjusting entries. That's our topic for today. So what is net income? Net income is just simply a residual or a result of revenues minus expenses. Hopefully if you're running a business, remember we talked about profitability before, your revenues hopefully are going to be more than your expenses. If you have $100 of revenue and $80 of expenses, then you have net income of $20. Okay? What if the economy was bad? What if it didn't go so well? What if we had $180 of expenses? Well, we don't have net income anymore. We got a problem. We got a net loss. Sometimes you show that in brackets there. We would have a net loss of $80. Okay? So whenever we're in Chapter 3, we're trying to measure what our net income is. We're trying to make sure we get our revenues and our expenses properly recorded in the correct period so that we can get a good number of net income. For a lot of businesses, for public companies, net income is a key driver. This is your key result for the year. How much money did you actually make? How much did your revenues exceed your expenses? That's the idea here. Okay? So a lot of different types of expenses that we could have. We could have rent, we could have salaries, we could have utilities. All those would fall under that expense category there to be subtracted from revenue. I want to talk about revenue recognition. There's a couple different concepts that I'm going to let you read through on the PowerPoints on your own, but let's talk about revenue recognition here. When should we record revenue? I've given you a couple, there's a little graphic here as far as when possible dates for recording revenue. We could, if we wanted to, record when a customer comes into our office and they request the service. Okay? So let's say we're a tax preparer and somebody comes in on January 15th and says, I want you to do my taxes come April. Okay? We could potentially think, we could say, well, we got some business coming our way, we could record revenue then. Alternatively, we could record when work is performed. So in our tax example here, we could do their taxes, let's say April 1st. Okay? And we might not receive the cash yet, but we'll bill them. So we could record when the work is performed, or we could record our revenue when our cash is received. Okay? Well, out of those here, what would be the best bet as far as, remember, the idea is we want to get a good number for net income. We want to have a solid net income here that's somewhat accurate, that gives a good indication of how well we did for the period. Which one of these would give the best indication of that? Well, we could kind of mark this out. This kind of doesn't make a whole lot of sense. Somebody could come in and request service, but later on they could change their mind. We really haven't done anything yet. So typically, we're kind of down to these two options here. Should we record whenever the work is performed or whenever the cash is received? Well, if we did this one, what would be the result here? Let's say this was April 1st, and we billed them, and they were supposed to pay by 6/30, 3 months later. Well, the result is they could possibly not pay down the road. So we could have recorded revenue here, but we might not actually get that money. What would be the alternative or the consequence of recording when cash is received? If we recorded revenue when cash is received, and we're trying to get a good net income number. So let's say we have 2012 and 2013, and we got revenue here, and we got expenses here, and net income. Let me make that a little bit bigger here for you. 2012, 2013. Revenue, expenses, and that results in net income. Okay? Well, if we were sitting in 2012 and we wanted to maximize our net income, so we want to have as much positive here for net income as we can, we would want to maximize our revenues and minimize our expenses, right? Because revenues minus expenses is our net income here. If we recorded it based on when the cash was received, what would we tell our clients to do? We got somebody who we've done some work for near the end of 2012. Okay, so maybe we're working here, maybe we're working here, but if we were recording based on the cash basis, when would we tell them to pay? Well, we would tell them, why don't you pay us here on December 31st, let us record it in 2012. The cash would be received on this side of the line for 2012. That would allow us to record revenue over here. Well, but what if we didn't do the work till later? What if we didn't do our work over here until 2013? Well, that would be a problem because we're recording revenue in one period, but we're not actually doing anything. The substance of the transaction did not really occur until later. It could be the same thing with expenses. What if we recorded our expenses when the cash was paid? Okay. Well, if we were trying to maximize our net income, what would you do with this timeline up here? So there's 2012, there's 2013. Well, we could have somebody who did all of our work in 2012. They worked for us throughout this period, but if we waited until the cash was paid to record our expense, let's say they could pay us on January 2nd. Well, that would allow us to record the expense over here, and that would be a problem because they actually did all the work in 2012. So in that example that we just had, if we had people who paid us in 2012 for the work we did right there, but we did not pay anybody for the work that they did for us until 2013. Well, now you got your revenue in 2012 and your expense in 2013, and that's a problem because our net income here is going to be overstated and our net income over here is going to be understated. They're really not matched up. We're not really looking at and properly recording when the substance of the transaction occurred. So our rule in accounting, remember we talked about GAAP? What is generally accepted? What is the correct way to do it? The correct way to do it is whenever the work is performed. That's when we're going to be recording our revenue. If somebody is working for us, that's when we're going to be recording an expense. This right here is the accrual basis of accounting. Okay, you'll see that in your slides, the accrual versus the cash basis. If we recorded revenue when the cash was received or we recorded expenses when we paid them, that would be the cash basis of accounting. And the idea is that this is not GAAP. This is GAAP. What's the reason why this is not GAAP? Is because we could manipulate our earnings. We could tell people pay us in 2012, and then we can make payments the very next day in 2013. Well, but our net income, we would be able to manipulate that by recording cash basis. What we're going to do is we're going to say, when is the work performed? That's when we're going to record our revenues and our expenses. So that way, if we do some work for people here, so we have revenue here and we have some expenses here, regardless of when we pay, we're going to record those in 2012. That's the accrual basis of accounting. That's the correct way to do it because it gives a better indication of what our net income is. How profitable were we for the period? We're not going to let our cash drive it. We're going to allow the economic substance of the transaction to drive it. Okay? So what we see in Chapter 3 is we have some adjusting entries to get our revenues and expenses properly stated for that particular period. Okay, so let's look at this. Here's our revenue. Here's our expenses. This is 2012. Now, as we were going through our different journal entries before, we looked at a lot of different journal entries for Chapter 2. We might not have recorded all of our revenues and all our expenses up to date. When we get to the end of the period here, so let's say this is 12/31 of 2012. Okay? We might not have recorded all of our expenses and our revenues up to date. Maybe we had not been paid yet, or we had not paid for it yet, and we had not recorded a journal entry here. When we get to Chapter 3 for our adjusting entries, what we're trying to do here at this particular date here with our adjustments is we're trying to, as of 12/31, whenever we're going to do our income statement and our balance sheet and produce our financial statements, we want all of our revenues and our expenses, our assets, and our liabilities to be properly stated as of this date. They might not be up to date at this point, so we need to make an adjustment for some of those things. Let me give you an example here. A lot of times your phone bill is going to come after the end of the period. So let's say we have our phone bill for December here. The service was provided here. They did not bill us until January 5th. Well, we probably did not, as a business, record any telephone expense for this before we get to the end of our period here. What we're doing in our adjusting entries is we're getting everything properly stated as of this right here. So even though there was no recording of our expense yet here, there was no recording of the liability yet here, we're going to do an adjusting entry to get our expenses and our liability recorded. That's the idea. We're going to get our financial statements up to date so that we can produce proper net income, a proper balance sheet at that particular date right there under the accrual basis. Okay? That's what we're trying to do. So we have several different types of adjustments. There's a slide there that says types of adjustments. We're going to walk through 4 different types. Each one of these different types is going to involve one income statement account and one balance sheet account. So we'll kind of work our way around. I'm referring to the grid that kind of looks like this. We'll start here and we'll kind of work our way around looking at the different types. Keep in mind what we're trying to do is we're trying to get everything up to date at the end of the year, properly recording our revenues and expenses, assets and liabilities. Each different adjustment is going to have one of these and one of these involved. Okay? Okay, so let's look at number 1. So we're in the bucket for assets and expenses there. Recorded costs are allocated between 2 or more accounting periods. So what we might have here, let's say we paid something ahead of time over here. The example we're going to look at is prepaid rent. Okay, so we paid for some rent at this date right here. We're going to say it's September 1st, so 9/1. Well, but this rent actually covered us for 6 months. We paid it ahead of time, 6 months in advance. Well, what has been used up? When we get to this right here is 12/31. When we get to 12/31, what has been used and what is left over? Well, if it's used up, well, it should be moved over to an expense. So we would say 4 months here have been expensed. What part is left for the future? Well, that would be an asset. And that would be 2 months. Okay? So in the slide there, I'm looking at type 1. It says cost allocation asset to expense. We say a company prepays $6,000 rent semi-annually. Payment is made on September 1st. So back over here on September 1st, what would we have recorded right there? On 9/1, we paid cash of $6,000. So we would know that we credited cash of $6,000. Well, what would we debit here? On September 1st, what does that represent? Does that represent an asset or an expense? Does it have future value or is it used up? Well, at this date right here, this has future value all the way until the end of February over here. So we would record this to prepaid rent. That is an asset. Okay? So that would be our journal entry on 9/1. The problem is we're not going to be recording expense every single day for our rent that has been used up. That would require a lot of work. That would kind of be silly. There's no reason to record this on February 24, or September 24, September 25th, etc. We'll just wait till we get to the end of the period here on 12/31. Okay? And then we're going to fix everything. We're going to catch it all up for the stuff that has been used. So when I get to 12/31, what exactly am I needing to do here? Here's my prepaid rent account. I put $6,000 in there on September 1st. My rent expense account, assuming I didn't have any expense from before this time, it currently doesn't have anything in it. Okay? So what am I needing to do? What should my final balances be at 12/31? Well, I just marked it over here. We have used up 4 months. We had September, October, November, and December that we actually used that rent for. So if it was $1,000 a month, we had $6,000 for 6 months, so $1,000 a month. Well, what I really want to do is I want to have not $6,000 in my asset anymore. I want to have $4,000 over here, and I want to leave $2,000 left as my asset because it has future value. Okay? So how would I show this in a journal entry form? Well, what I want to do is I want to take some of my asset and I want to move it to expense because it's been used up. Okay? So that's essentially what I'm going to be doing right here. Is I'm going to take some of my prepaid rent asset that I previously recorded. I need to move it over and adjust it to rent expense. So my rent expense is going to go up. My prepaid rent is going to go down. They both have debit balances. So I'm going to say rent expense for $4,000 and prepaid rent for $4,000. That recognizes my expense that I had not previously recorded. So now I got an expense recorded for that 4 months right there. Prepaid rent is going to reduce my $6,000 balance that I recorded on September 1st. Now on 12/31, I got my new balance for my asset, prepaid rent. This is the balance that's left over as we go forward. So for this particular adjustment, we moved part of our asset to expense. We shared that cost. Even though it was paid over here, we're not going to recognize the full expense in 2012 because it relates to both 2012 and 2013. It was used up. It was incurred in 2 different years. So I want to divide that expense up between the 2 different years so I can get a good number for what my net income is. Okay? So that's number 1. Let's look at number 2 here.